Julie, it's time for On the Call. We're going to check in with Wall Street analysts on the biggest stock stories of the day, and we're watching energy companies. As Cowen downgraded multiple oil and gas companies after OPEC failed to strike that deal on production cuts. Joining us on the telephone to discuss this is Cowen senior analyst Gabriel Daoud. Thank you very much for being here. You talk about the goalposts being moved. Can you help us understand, in the old days, maybe a month ago, a year ago, people would have been, as we said earlier in the program, long oil, short nat gas. But that's totally been, that whole kind of trade strategy has been totally blown up. Are we going to see a collapse in price, not only in oil, but nat gas continue for several months?
Sure, and my pleasure. Thanks for having me. You could certainly see oil continue to drift lower, particularly as Saudi obviously is talking about ramping production up to 12 million barrels per day from sub 10 million barrels per day on, as you mentioned, the breakdown in the OPEC Plus agreement between OPEC and Russia. But this could, as you mentioned, potentially be supportive of natural gas prices. I'm sure, as you know, gas production is associated with oil, and as producers potentially lay down activity, which we've already seen in oily-focused basins, that could actually have a positive impact on the supply side of natural gas as natural gas volumes continue to move lower. And you could potentially see a situation where 2020 natural gas is actually undersupplied by a significant amount, which follows many years of oversupply, as you mentioned, as a number of operators. And U.S. natural gas production has overall grown at a significant clip since the shale revolution began in about 2008, 2009.
Gabriel, you say in your note today we're far from the shale low. Are we going to see a wave of bankruptcies like we did in 2016, default? Is that kind of carnage coming?
Yeah, Julie, it's a great question. And yeah, I think in short, we do expect a number of restructurings to take place similar to 2016. It could be even worse to the last time oil touched these lows in early 2016, because as you remember, in 2016, capital markets were extremely supportive of the sector. There was a record amount of equity raised across the space in 2016, which helped recapitalize balance sheets. And we think this time around, capital markets will be less supportive. We think effectively the equity markets and even the debt markets are closed for most operators. You did see a number of debt issuance earlier this year or a couple months ago from what would be kind of characterized as some of the top and high-quality producers. But more or less, capital markets are closed, and if oil prices were to persist in this $35 to $40 barrel range over the next couple of years, you could certainly see a wave of bankruptcies accelerate, and you could certainly see more than what we saw in 2016.
Jared Blickery here. We have the Saudis threatening to crank up production to 13 million barrels a day from just below 10 in the recent months. You got the UAE cranking up to 4 million. Is this a bluffing game? Are they actually going to come through with these production increases? And how long can it continue without seriously impacting oil prices?
Sure, and not trying to get into the heads of foreign leaders, but that's the talk coming out of OPEC and the UAE and Saudi right now. Obviously, historically, Saudi's actually never produced above 11 million barrels per day, so there could certainly be some skepticism in the market over their ability to do so near term. But if they do ramp towards 12 million barrels per day in April, you could certainly, as I mentioned earlier, see oil continue to drift lower. And the numbers, you mentioned the note that we did publish this morning, we actually don't even assume that Saudi gets to 12 million barrels per day. And even with that, if Saudi holds around 11 to 11.5 million barrels per day of production, you still see a supply-demand imbalance to the tune of about 3 million barrels per day in 1Q. So it's a pretty nasty supply-demand situation, which could obviously continue to impact the price of oil. And in terms of U.S., we do think this is obviously sparking a big reduction in activity. You've seen a number of large operators already come out and discuss intents of dropping rig activity and scrapping 2020 plans, which were only issued a month and a half or so ago. And ultimately, this will translate on the supply side with U.S. declining, but it'll take some time to work its way through the system. So that's part of the reason why we do think you're in a $35 to $40 barrel world over the next couple of years, and then potentially you have a call on shale growth in 2022, given an undersupplied market at that point.
All right. Cowen Senior Analyst Gabriel Daoud, thank you for being here on The Move.
Thank you.